very helpful topics. Thank you very much, Nenad. I'll now leave you with the audience. Thank you very much, guys, and have a good time at the webinar today.
Thank you very much, Mikhail, for such a nice speak, and very, very good. It's very true that you say that. People should always take into consideration to invest, and if they are confident enough with the proper knowledge, they should all start to trade. So guys, today we will talk a little about the moving averages and basic candlestick patterns. Most of other webinars over the net probably will give you less examples of candlestick patterns than I will do today, but due to my previous webinar about advanced candlestick patterns and due to slightly modified market conditions, I will present you a little bit more about basic candlestick patterns. Those patterns are not the same as they were a few years ago. So there are more of those basic candlesticks. So pay attention closely today to what I will speak of, because it will be very important to know these kind of things. So when we start doing trading systems in some of our future webinars, all of this knowledge you have gained through all of these basic webinars will come through. So pay attention to this. So before we start, as always, there is a risk disclaimer. By accepting this risk, you will proceed further. So we can proceed further, of course. So today's agenda: candlesticks explained, basic candlestick patterns, moving averages explained, types of moving averages, and how to use it. So how we are going to use those moving averages. Let's start with candlesticks. Most of you know what candlesticks are, but let's say that today candlesticks are more prominent than ever. Traders trade with candlesticks more than with bar charts and with other point and figure or range bars or other things. So candlesticks are mostly widely used today. Japanese originally began using technical analysis to trade rice, and that was happened in the 17th century. So that early technical analysis is a bit different than USA version, which was initiated by Charles Dow around 1900, year of 1900, but many of the guiding principles were very similar. So those principles which are similar are basically that price action is more important than use, and that means the what factor is more important than the why factor. What factor represents price action? It means that all known information is reflected in the candlestick, all known information about a price. Also, buyers and sellers move markets based on expectation and emotions. Markets fluctuate and the actual price may not reflect the underlying real value. So that is when news and fundamental analysis kick in to, I will quote this, screw the price. But remember always, everything is reflected in candlesticks. Steve Nissen, he brought candlesticks charting to Western audience. As we say, candlesticks are pure price action and reflect the mind of traders. Everything what I know of candlesticks, I have Steve Nissen was a person who taught me. His books, his webinars, of course, also I have a lot of screening time. I have my own candlestick patterns which are not known by everyone. Maybe 5 or 6% know about my candlesticks, my personal candlestick patterns, but mostly I have been taught by Steve Nissen. So the formation of the candlestick, and it's a good thing, is always the same. If you open MetaTrader 4, you will see that by default, white is bullish candlestick, black is bearish candlestick. and we will talk in that context today. So white is bullish, black is bearish, it's by default on MetaTrader 4. This is basically a candlestick. So the candlestick consists of three parts. It's upper shadow, body, and lower shadow. In order to create a candlestick chart, we must have a data set that contains open, high, low, and close values for each time period we want to display. The hollow or filled portion, depends whether the candle is bullish or bearish, of the candlestick is called the body. And some people know it as a real body. The long thin lines above and below the body represent the high and the low range and are called shadows. Some call wicks, some call tails. I call it sometimes wick, sometimes shadow. It doesn't matter, it's all the same. The high of the candlestick is marked by the top of the upper shadow and the low by the bottom of the lower shadow. So if we have upper shadow, a lower shadow, or upper wick or lower wick, that represents on higher time frame support and resistance level. And those kind of support and resistance level is the actual immediate interim support and resistance. So if you're not sure what support and resistance indicator you should look at, always open 1 hour or 4 hour time frame and mark wicks, mark upper shadows, lower shadows, and you will get resistance and support. And that is the actual, the most valid resistance and or support. So if the Forex pair close, for example, is higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. If the Forex pair closes lower than its opening price, a filled candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. So this is a basic candlestick formation. So pay attention to that. So long white candlestick shows strong buying pressure. Long black candlestick shows strong selling pressure. If you're new traders, and I presume that most of you are new, but this is also can be applied to advanced traders. Always concentrate on learning basic candlestick formation on higher time frames. Those basic candlestick formations are formations which I will show you today. Higher time frames are much reliable than lower time frame candlesticks. Candlesticks usually don't have any significant impact on trading below 15-minute time frame. So if you want to use candlesticks on 5 or 1 minute time frame, it won't make any impact, especially if you trade a multiple trade time frame analysis of multiple time frame method. So candlestick patterns are insignificant on 5 minute and 1 minute. They can be used as entry points and dynamic support and resistance on 15-minute time frame. That is when you make a breakout trade or when you want to make an entry based on trend. On 4-hour and 1-hour time frame, candlesticks mark important support and resistance levels. As I said on previous slide, if you want to see a good support and a good resistance and a good range, just open 4-hour time frame or 1-hour time frame and look at the wicks of the candlestick. It will represent a dynamic support and resistance level. Usually when those wicks are broken, we can have a trade, right? So candlesticks can be used for entry points, continuation, that means scaling in. Scaling in means adding new position or reversals. So let's start with candlesticks explained. The first is white Marubozu candlestick. That is bullish white Marubozu candle. This is basically one candlestick pattern which represent a strong bullish candle, Marubozu or a bully, and that usually marks strong buying into support or a resistance breakout. For every candlestick, I will show you a practical example. So, Marubozu candlesticks are candlesticks that represent a strong buying pressure, either of the support, or if it goes through a resistance, that means that the strong momentum has broken the resistance and we can expect a buying pressure. These are three types of Marubozu candles: white closing Marubozu with a little of the wick to the downside, then white opening Marubozu where there is a small wick to the upside, and the pure Marubozu candlestick without any wicks. So these are the examples of Euro USD chart on daily time frame. And I have marked with the blue pattern, I have marked Marubozu candlesticks. So look at those candlesticks. All of those big bullish white candlesticks are Marubozu candlesticks. So they can be contained in a formation. They can be contained in a tree upside down or inside up, or it can be contained in a white soldier pattern. It can be contained as bearish, as bullish engulfing candle. So everything about those candlesticks can be explained as bullish, completely bullish. If you see this candlestick, always wait for a retracement, then buy on Fibonacci support. If you want to trade naked, one of methods I usually trade is, this is Marubozu candlestick, right? After the close of Marubozu, I will draw a Fibonacci retracement tool from the bottom to the top, and I will get a retracement. So trade around Fibonacci levels. So trade about a little around 50 levels. Euro USD likes 50 retracements. So after initially after white Marubozu opens, wait for a retracement, open a retracement tool, draw a retracement, and wait for the price to touch either 38.50 or 61.8 Fibonacci. Then you can trade it. You see how this candlestick proved a valid buy after a retracement. You see also this. After this retracement, it was a buy. Also here, after this retracement, it was a buy. So always wait for retracement and don't go long into resistance after Marubozu has formed. Always wait for a retracement, because usually there is a chance after big candlestick that the price will retrace, then continue to go up. So to be sure, always wait for a retracement. Bullish engulfing or engulfer candle. There are two candlesticks in configuration. First candle is a bearish candle, and we need to have a downtrend. After the first initial candle, the second candle completely engulfs the first, and that means it's completely eaten by the first candle. So look at this. This is a downtrend, right? And this is a body of the first candlestick. After this candlestick closed, usually it closes around the support. This candlestick completely eats the body of this previous black candlestick. So after this has happened, we usually know that the price will reverse and continue to go up. If the difference between the support and the closing of the price is not big, is not much, we can immediately open a trade. If there is more than 30 pips difference between support and the closing price of the engulfing pattern, we would wait for a retracement to enter a trade. This usually marks the start of new trend on higher time frames. Don't look at 1 minute, 5 minutes, sometimes even 15 minutes can deceive us. But try to spot it on higher time frames, namely 1 hour and 4 hour charts. So this is bullish engulfing pattern. Next, candlestick, and this is the example, of course. You see, marked with the blue ink, there are 2 bullish engulfing candles. So look at how those candles ate the previous candles. Look at this bullish candlestick, and they are close to the support. So this is a range. After this is also can be traded in the ranging markets. We don't have to have a downtrend to support. We can have an uptrend and then a consolidation. This is accumulation phase. After accumulation or ranging phase is gone, we have a distribution. Then goes markup trend, and that's it. Again, an uptrend. So these 2 candlestick patterns have signaled us that this resistance will soon be broken. So we knew that of course, we were close to support. We could make an entry with just around 30 pip stop and we would be good. So bullish candles at a support in uptrend. So uptrend, bullish engulfing candles in the ranging accumulation phase of the market. So that is 3 important things to place a long trade. So we can see that the trend has been respected and the price has really gone to test those levels. So bullish engulfing candle, always pay attention to that. This is one of the mostly traded patterns in Forex market, and one of most reliable patterns on higher time frames. Because it's clear, it's very clear. It represents the strength of bulls, and it represents that the trend either will reverse or continue in the same direction. Hammer. Hammer is also one of most tradable patterns. First, we need to have, usually we have a downtrend. Then, when it's close to support, the hammer appears. Hammer, there is no upper wick, or there is a very, very short wick. That is variant 2, like this. Very, very short wick. This is not a hammer. So, either without a wick or with a very, very short wick. So we buy into it after the price has break its highs. It needs a strong confirmation on higher time frames. We have a downtrend and we have a support. Or there, doesn't matter. If the prices make a hammer of the support, we will buy if the price breaks the top of the hammer. Of course, we won't wait 3 or 4 candlesticks. We prefer next or after that, or a candlestick after that. We prefer to go above its highs. But the next candle shouldn't break the support. So after this, it's usually, if we are short, we want to exit the trade, or if we are unnecessary, if we are not sure where the price will go, we want the price on the next candle to break its highs, and that is a very good sign that the price will go up. So that is a bullish hammer. You see? This example, you see how, in this example, the price has formed a hammer just off the support in uptrend, in accumulation phase, and then in the next candle, the price is broken to a resistance, is broken to a top of the hammer, and proceeded to go up. So this is a hammer. In next candle, it broke through the top of this hammer and proceeded to go up. First, we have uptrend, then we have accumulation phase or a ranging market, and then we have distribution or start of a new trend. So this is it. Hammer top is broken and the price is going up. It's not hard. See? Piercing line pattern, also very common in Forex market. The first candle is a black momentum candle. This is a black momentum candle. Usually that will deceive traders that the price will go and continue to go down. But on the next candle, you see, candlestick opens up, goes slightly down, but closes more than a halfway into the body of the first candle. You see? But the second candle fails to close above the body of the first candle. This is very easy to spot. This candle is bearish candle and this candle is bullish candle. You see? But the top of this bullish candle hasn't eaten the first candle. So it has closed just below the top of the first candle. And this is piercing line pattern. It's very hard to, it's very easy to spot. And if you spot that pattern, go immediately out of the short trade and wait for a sort of retracement or a bullish pattern on lower time frame, and then you can enter the market. So this is a sign usually of reversal, that a previous downtrend has stopped, that is near the exhaustion point, and the new trend is about to emerge. So this is a piercing line pattern. You see? Look at this fall. Look at this drop of Euro USD. After the trend has, you see? And you see how this candlestick, even though it has a wick, it can have a wick, but the body has closed just above into this candle. You see how the price is respected. This is a second variant of piercing line pattern. The first variant would be this. This is the body. So this is the first variant. If you see the candle like this. And this is the most reliable. You see, this is the most reliable. But sometimes you will get a pattern like this. This is also a piercing line, but second variant of the piercing line. You see, it's the buying of the support. So it's not hard to spot this pattern. Tweezers pattern. So we have two candles in configuration. First candle is a bearish candle and it closes near the support or daily low. Second candle completely negates the first, so it erases all the losses of a previous candle. Bullish tweezers have a small wick at the top of the candle, a railway pattern. It's almost the same as the tweezers, but without the wicks. So let's concentrate on tweezers, and this is tweezers pattern. This also can happen in the Forex market after the strong news. So pay attention to this pattern after some strong news or fundamental release. So the price is in downtrend, then it goes close to support, and then look at this. The first is bearish, and some traders may think, wow, this will go down. But the second candle, it's bullish candle. But you see, it's tweezers. It looks like tweezers. So it was enough for it. And remember this, guys, this is daily. So this pattern proved to be good for some, well, 300-400 pips. So you see, this pattern on a higher time frame can yield a perfect results, especially if candles are close to the support. You see how the price went up after the tweezers. Also, again, pay attention to that after strong news release or after NFP. Morning star pattern. There are 3 candles in configuration. Morning star is characterized by downtrend or a retracement in bullish trend. First is a black candlestick, second candlestick is a doji that gaps in the direction of downtrend, and third candlestick is white bullish with up momentum. This is bullish morning star. You also have some good example of bullish flag here. You see? We have 2 patterns. This is a flag. We had a webinar about chart patterns. This is a flag. And this is 1, 2, 3 morning star. You see, we have some slight downtrend. Then the second is a small candle. And the third is upward momentum candle. So this is a morning star pattern. 1, 2, 3 pattern, 3 candlestick formation. After this, the price has broken to the resistance of this flag and continued to go up. So this is morning star. Rising 3 metals. Also, pay attention to this very careful. This is one of continuation patterns. So this is not a reversal pattern. This is one of the strongest continuation patterns. It's spotted in uptrend. First candle is strong bullish candle that retraces next 3 or 4 candles. But the second, the third, and the fourth candle remain in the range of the first candle. Those are characterized by consecutive lower highs where wicks may slightly vary. Fifth candle breaks resistance to the upside, and that is called bullish continuation. And this is a very familiar pattern. You have probably seen it a lot of times. So the first is bullish candle, you see? And then the next 3 or 4 candles, or 4 candles maybe, can deceive us that the price will continue to go down. You see? But this is a retracement, and neither of those 3 or 4 candlesticks hasn't broken the low of this first candle. This is a retracement in uptrend. So after the third, and sometimes after the fourth candlestick, the price continues to go up. If there is 3 candles, that is called bullish rising 3 methods. Sometimes there are 4 candles. But the thing is that neither of those 3 or 4 candles should break the low of the candle. So there can be a very good risk to reward ratio if you trade rising 3 methods. This is an example. This is not a perfect example, but still it is rising 3 methods. The first candle is here, second, third, and fourth candle neither of them has broken through the lows. And then if you just look at the bodies of the candle, just observe the bodies of the candle. Ignore the wicks. You see the bodies. In this candlestick pattern, bodies are important, not the wicks. Don't look at the wicks. You see the bodies, it makes a bullish flag formation, the bodies of the candlestick. And there is, first is a bullish, close to resistance. Then there is 3 candles, but neither of them has broken to the support. And the 5th candlestick is a bullish candlestick. And this will mark the continuation of uptrend. See? that is called rising tree methods. And this is very familiar pattern because it will go like this, right? Like this, like this. This is bullish zigzag, bullish trend, or bullish rising tree methods. And finally, three white soldiers. Three white soldiers are also one of common patterns on Forex market. Candlestick pattern can be taken as a reversal and or continuation pattern. When it's close to support, then it's reversal, but it can be connected to a strong uptrend when it makes a continuation pattern. Candles don't have to be white Marubozu candles, but it's important that every candle is making a new high. So this is an example of three white soldiers. I usually treat this candlestick pattern as a continuation. So if you are in a position, then you should wait. You should not close the position after these three candles have initially closed, because usually after those candles there will be another push to the upside. So these are 1, 2, 3 white soldiers. If there are no wicks, that means that white soldiers are perfect, and that there is a very strong buying momentum. So just always take a consideration that those candlesticks without wicks are momentum candles, and they are much stronger than candlesticks with wicks. So three white soldiers. Now we are continuing with bearish candlestick patterns. Black Marubozu is the same as white Marubozu. So it defines a strong sell-off the resistance or strong buying of the support. They're also known as momentum candles. If there are wicks, the candles are not that prominent, not that strong. But if there are no wicks, that means the candles are very strong. And if there are wicks, that means that candles can be Marubozu, strong momentum candles, but not as strong as without wicks. All examples of black Marubozu. I trade it as white Marubozu. After the candles has closed and formed a Marubozu, we wait for retracement. You see the retracement here, and it went down. You see here, open a Fibonacci, draw retracement tools, and wait for the price to go near. And then yet again, it proved to be good. After this, we had also a slight variation to the downside. So after Marubozu candles appear, you see how the price usually respects those candlesticks. They are stronger if they are in downtrend, as in this example. We have a downtrend, lower lows and lower highs. In this uptrend, we have Marubozu, but it only signals a small retracement. We can trade it, but I prefer it to trade it only if they are in downtrend. But sure, in this example, you can see how it can be scalped in uptrend. See how they can be scalped in uptrend. But always go for them in a downtrend. Next is one of most common patterns in Forex market. It's a shooting star. First, the market is characterized by a prevailing uptrend. The first candle of the pattern is a white candlestick. On the second candle, a small body at the lower end of the trading range is observed. Color of the body is not important. That's it. The upper shadow of this second candlestick should be at least twice as long as the body. There is almost no lower shadow. So the perfect example is this. But also there can be a slight variations, such as this, for example. Or we can see like this. This is a perfect shooting star because the body has no lower shadow and the length of the wick is triple to the body. usually after strong news releases, and usually they signal a fake buying. Fake buying. You have probably noticed many times after the news that the price will make this candle, but at the close of the candle it will look like this. The higher time frame is, the stronger candlestick is, the stronger candlestick pattern is. So this can be a signal that the reversal will continue. And the good example is here. Shooting star near the resistance is almost always a sure hit. Or if it's not a sure hit, it's a loss, but with very, very small loss. So risk to reward ratio in this one is very big. Especially we have a big uptrend. This is crucial level for the pound, right? And you see shooting star into the resistance, and then you see the reaction, how it went down. So the shooting star into resistance can be a good start of a new trend or a reversal. Bearish engulfing, it's same as bullish engulfing candle. The number of candlestick in configuration is 2. First, the market is characterized by prevailing uptrend, a white body is formed, and the black body that is formed on the second candle completely engulfs the white body of the preceding candle. So it's the same as bullish engulfing candle, but this is reverse. This is bearish engulfing candle. And you see one of those examples. Here we just want to see the bodies. We want to see the bodies. The body of this candle is completely engulfed with this candle body. See, this is also, if this candle was a little bit higher, this could be also an engulfing candle. Those candles are widely used and can be good if traded close to the support, as in this example also. You see, engulf this candle, completely engulf this, close to resistance, and after that we had a shooting star, guys. And if you see the pattern like this, this is a no-brainer trade. This is resistance. This is bearish engulfing candle, and this is shooting star. You can usually, if I see this, I would go heavy on the trades like this, because you see this is resistance, but this resistance is more significant, and it was tested 2 times. 2 times it was a no hit, and then after the shooting star and bearish engulfing, the candlestick went down, almost forming a good 3 black crows. It's opposite of white soldiers, it's called 3 black crows. But you see, it wasn't happening. Then yet again it was tested, and then yet again on bearish engulfing candle the price went down, breaking the support, and then it really went down. Falling 3 metals here, you will see the pattern later, and then down. Falling, making a bearish flag, and then went down. Bearish flag, falling 3 metals, and then down. You see how the price technically respects those candlestick patterns. Evening star, also one of most commonly used candlestick in the market. First, the market is characterized by a prevailing uptrend, then we see a white candlestick as the first candle, and then we see a short candlestick on the second candle that gaps in the direction of the uptrend. A black candlestick is observed as a third candle. This is evening star formation. Evening star formation close to resistance. You see how the price went down after the evening star showed up. So evening star close to resistance, and then the price went down. It is really a good trade if you trade it close to resistance. Then we have dark cloud. Dark cloud is almost as the same as a piercing line, but it only appears in bearish markets. The market is characterized by a prevailing uptrend, then the white candlestick appears as the first candle. A black candlestick opens up on the second candle and it closes more than halfway into the body of the first candle. The second candle fails to close below the body of the first candle. Almost is the same as piercing line, but close to a big resistance. You see, again, no-brainer trade. Resistance and then dark cloud. You see, it went down, it was a start of downtrend, then the candlestick appeared close to resistance, and next candlestick almost completely ate it. But you see, the body is not engulfed. It's a little bit higher than the close of this first candle, and this is dark cloud. You see, this is a little higher, and this is also a little higher. So this is a dark cloud. If it was like this, we would call it a bearish engulfing candle. And you see, it's daily. Really, on 1 hour, 4 hour, and daily time frames, those candlesticks are great. 3 black crows, the same as 3 white soldiers, but it's in bearish market. The market is characterized by a prevailing uptrend. 3 consecutive normal or long black candlesticks are observed. Each candlestick opens within the body of the previous candle, and candlesticks progressively close at new lows below the preceding candle. Also, a sign of continuation. If you see the sign of continuation, don't close the trade. Wait. You see, for example, you have entered here in this engulfing candle, but you have also your long-term trader or mid-term trader. This is daily time frame. You want to see the continuation. So you waited. The price has gone a little bit higher. Then it went here. And then usually after 3 black rows, the price continues to go down. So it's usually a sign of a continuation in the market. Hanging man, this is also a common pattern in bearish market. The market is characterized by uptrend. A small real body at the upper end of the trading range is observed. The lower shadow of this candlestick is at least twice long at the body. There is almost no upper shadow. This, the only and one and only candlestick, is called hanging man. And this is where it makes a perfect example. You need to be patient for this. So if this happens, we see an uptrend, we see a big resistance. 1, 2, 3, 4, 5, 6, 7, 8 tests, 8 unsuccessful breaks through this resistance. And what has happened, you see, a hanging man pattern here appeared at the very resistance. It's near 20 points resistance. After that, it's a no-brainer trade. You see? Then 1, 2, 3 black crows, and then a continuation to the downside. So you see how this trade could have traded for those who trade candles. Wait for a candle to make a pattern near resistance. Hanging man spotted near the resistance. We enter a trade at the close of the hanging man. Then the price goes down, makes falling 3 methods, a bearish flag. Then it makes 1, 2, 3 consecutive bearish crows, and then continuation to the next support level. See, it's not that hard, guys. If you want to trade like this, you need just to practice. But now you see it's not that hard. Next, falling 3 metals. This is one of most reliable continuation patterns. I showed you in previous examples. This is zigzag. This is zigzag trend pattern. You see? This is trend pattern, guys. First, we have a candle as a long black candlestick. Can be Marubozu. but then there is a slight retracement within a defined borders. It shouldn't go over the top of this first candle. There can only be a fourth candle, but the fourth candle shouldn't break the top of this first candle. After this formation, there is usually a bearish flag, and the price continues to go up on the fifth or the fourth candle. So if you see this pattern, you can trade it with a good confidence, because it's usually a good sign of a continuation. Early entry is spotted here around the fib retracement, and a little bit of late entry can be traded after the close of this candlestick. But the traders usually go here. When the low of this second candle has been broken, traders usually enter here. But if this happens, you proceed with the trade, waiting for next support. And also it's good on higher time frames, as always. And you see the examples we had on previous slides, a few examples, but we also have here on this example a downtrend. Sorry. Then we have following three methods. First candle 1, 2, 3, and then 4 candles goes down. We can trade it here. You see how there was a slight range, then it went down. Also here 1, 2, 3, 4 candlestick. But on the fifth candlestick, it again went down. So if it's very close to support, you might consider a scalp trade. If it's not very close to support, like in this particular example, you can wait a little bit different. A little bit longer, sorry. Now guys, if you have any questions concerning those basic candlestick patterns, I will answer. If there are no questions, we can proceed with moving averages. I will show you how moving averages can be traded, and this will be a slight introduction to moving averages. And when we deal with the systems, you will need to know all of this knowledge for the next set of webinars when we do some trading strategies and systems. So please pay attention to these introductory webinars for you if you want to trade with successful risk to reward. So if there are no questions, and I can see there are no questions concerning candlesticks, we can proceed with moving averages. So what are moving averages? I won't be very long, but I need to tell you a few things, and now remember this once and for always concerning moving averages, because there are many traders that ask me how I use moving averages. I will tell you there are 3 ways. Just be patient, I will explain. Moving averages are commonly used to identify trends and reverses, as well as identify support and resistance levels. So they are frequently used in technical analysis, showing the average value of a particular pair's price over a set period. So they measure momentum and define a dynamic level of support and resistance. So they lag. That means they are not leading indicator. They are lagging indicator, and they usually present us with a fact which has already started. So if you want to see a trend with moving averages, you will see a late trend, because moving averages lag. They never should be used in ranging markets as entry by a crossover. So never, guys, to be used in ranging markets as entry by a crossover. What does that mean? For example, we have a range, and the price goes like this. And you want to trade moving averages, crossovers. No, don't do that. Never, guys. Never trade crossovers. I personally never trade crossovers. I don't trade it neither where there is a range. I also don't trade it neither when there is a trend. I never trade crossovers. Why? Because crossovers are an old way, and big guys today know that they will eat every account which trades only by crossovers. When moving averages appear some time ago, well, that was one of heaviest trading methods, and people could easily make money with trading crossovers. And then when big banks and big traders have got into that stuff, they knew what retail traders were doing. They always try to screw, quoted screw, our retailer traders by giving a false signals. False signals are commonly spotted in trading crossovers. For example, you want to trade 13 and 20 moving average and you wait for a crossover to trade. My advice is don't do it. Don't do it, because you will surely lose a trade. If it's not the first trade, then that will be a loss in one of your next trades. Don't do it, guys. So, types of moving averages. I hope, yes, this is important. They are best used as dynamic support and resistance. This is what I do. I use it as dynamic support and resistance. So, if I have, for example, a moving average here, and the second moving average here, for example, 8 and 12, and the price goes here and starts to reverse around these levels, I would usually open a trade. I don't need stochastic to open a trade. I just want to see a price reaction. So, as I always say, don't predict, react. So you want to see reaction. If you see like this, for example, moving averages, and you have a downtrend, and the price started to retrace, then why not? You can try to make an early entry with risk to reward very low, because stop loss should usually be there, and you can make an entry around those moving average dynamic support and resistance. That is very good for me, because I don't use it at crossovers, only as dynamic support and resistance. Also, there is also one other method that I will show you later that's called price crossover, not moving average crossover. So a little bit about types of moving averages. You probably know simple, exponential, smoothed, and weighted. I won't go into details of custom-made moving averages. There are many sites that use custom moving averages such as GMA, JMA, IMA, or some call like that. But you know, those are all custom-made. Most common are those integrated into your trading platform. Simple, exponential, smoothed, or weighted, or low or weighted moving averages. Some platforms use LWMA for weighted moving averages. But weighted is weighted. When you see W near the moving average explanation, you know that is weighted moving average. So, simple are the easiest to plot, but also the most prone to distortion. Exponential achieve the benefits of weighting combined with isoplotting, and they are mostly used. Most commonly used are exponential moving averages. Smoothed is a sort of blend between a simple and an exponential moving average, only with longer period applied. They can be good. I didn't test it a lot, but those kind of moving averages can be also good. And weighting moving averages are difficult to plot but are very reliable. I want to use exponential moving averages in my analysis, and mostly I use exponential. Weighted moving averages can be used in some systems concerning momentum trades. I will show you that in some later webinars, but now let's concentrate about those simple exponential and exponential moving averages. Exponential are, as I said, mostly used in Forex market. most commonly used. Practical use of moving average covers three ways: moving average crossovers, support and resistance, and price crossovers. Price crossovers. This is an example of moving average crossovers. I told you I don't trade it. I don't trade it. This is, for example, moving averages. This is an example if, for example, there is another moving average that crosses here, or there is another moving average that crosses here, or there is another moving average. But this is, you see, this was 2 or 3 years ago when those kind of moving averages worked. We, professional traders, prefer to adapt to market conditions. These kind of crossovers are hard to gain. It's very hard to gain on moving averages crossovers. So basically, there are mostly 2 of those averages crossing over, and they are combined to look like this, for example. And you trade the crossovers of moving average. Today, I really don't recommend that kind of trading. I really don't recommend the trading moving average crossovers. One of successful ways to trade it was some 3, 4, 5, 7, 8 years ago. Today, it's up to you. So, again, this is how I use moving averages as dynamic support and resistance levels. Let's say that we have 3 moving averages, 30, 50, and 100 moving average. 30, 50, and 100 moving average. You see how the price reacts to those levels when there is uptrend. You see the price reaction. First there is a convergence, and then you see how the price reacts. It goes off the supports, One of trading methods is using 30, 50, and 100 EMA for trading. But they can also be effectively used at 30, 50, and 100 SMA also. One of the systems I teach is using 3 SMA. So this is one of practical examples of using 3 SMA method. And you see how the price reacts to those levels. It respects it a lot. You see, when it's close to support, we buy it. When it's gone below this point, we don't take any trades. This is one of the ways how I show you examples. So this can be taken as example of dynamic support and resistance levels. And the third way is also can be good. I used it some time ago, and this is called moving average price crossovers. So we have only a single moving average plotted on the screen. Let's say that is 8 EMA. And you see how the price reacts to moving averages. We don't have another moving average, so we have only one moving average. That is 8. 8 EMA. 8 EMA. Okay. 8 EMA. Moving average. And we need to know the trend on, let's say, 1 hour time frame. We open 1 hour time frame. We draw a channel. We can see that the price is in downtrend, and then we move in 5-minute time frame and wait for the price to retrace, then cross over of the moving average. So you see, this is a retrace and this is the crossover here. This is the retrace and this is the crossover. Then again a profit, then a retrace and a crossover here. Then retrace and crossover here. Retrace and crossover here. Retrace and cross over there until it breaks the channel. Then it goes again. You see, there is no crossover, then price retraces, no crossover, and here again a crossover. You see, a perfect example how you can use crossovers. And that is from time to time one of my entry methods. price crossovers, not moving average crossovers, price crossovers. So guys, if you have any questions concerning, I really tried to be as short as I could be, as informative as I could be, because there is a wide subject, candlesticks, moving averages, but all one in on shortly, this is the what you need to know, either if you are experienced or new trader. This is what you should all know of. This is really 70% of the knowledge about moving averages and candlesticks. So you only make advanced methods of trading, but for starters and even for some intermediate traders, this can be very good if you have a feeling for the market. If you have a good feel of the market, you can use some of these kind of methods. So moving averages and candlesticks are very important also to know for our next set of webinars, and I will make a plan for that soon, but please have a knowledge of this first prior to moving to our next set of webinars. So guys, if you don't have any questions, I want to thank you for attending this webinar. I hope that you have learned a few things or a lot of things if you have never met with candlesticks and moving averages, and you can expect my analysis tomorrow. I think that Admiral Markets blog will soon start a global blog. Not local blog is doing fine, but Admiral Markets global blog is having some break, I think. So I think that it will start soon. I will post my analysis on Admiral Markets Facebook page. Don't forget to like Admiral Markets. Also, I will post my analysis on Forex Factory, Worldwide Investment, and Admiral Markets blog. If there is any questions, don't hesitate to ask me. If there are any misunderstandings, don't hesitate to ask me even on Forex Factory Spiders. Then I will be here with new analysis and with new set of webinars. For now, go over. This webinar is being recorded, so if you are not sure about this, go over again, reload it, and try to listen from the start. So I wish you all happy week. I wish you all a good and green pips, and talk to you guys very, very soon. Cheers, and thank you for your attention. Bye-bye.